If you're a senior living in the United Kingdom and you have been worrying about your property, your pension, and whether your retirement savings will actually last through these uncertain times, then I need you to stay with me for the next few minutes, because what I'm about to share with you could genuinely change how you think about your home and your financial future. The UK property market right now is not what it appears to be on the surface, and if you are someone who bought your home decades ago expecting it to be your nest egg, there are some important developments happening both here and abroad that you absolutely need to understand. Let me start by telling you what is happening across the Atlantic in the United States, because believe it or not, what happens over there often gives us a preview of what is coming here to Britain. President Donald Trump has recently announced something quite remarkable. He wants to ban large institutional investors and mega corporations from buying single-family homes. Think about that for a moment. The American government is stepping in to stop big money from competing against ordinary families trying to buy houses. But that is not all. He has also directed hundreds of billions of dollars into mortgage bonds, and the reason for this is fascinating. When the government buys these bonds, it actually lowers the interest rates that everyday people pay on their mortgages. The whole idea behind these moves is to revive what Americans call the American dream of home ownership. Now here is why this matters so much to you and me here in Britain. Governments do not make interventions like this unless there is genuine strain in the system, unless corporate landlords have become such a problem that ordinary people cannot compete, unless mortgage rates have climbed so high that families simply cannot afford to buy homes anymore. And here is the crucial point that I want you to remember. The United Kingdom tends to follow in the footsteps of the United States. When American interest rates go down, ours typically follow. We are often just a few steps behind in the same economic journey, and that means what is happening there right now could very well be a preview of what is coming here. Now you might be thinking that things look reasonably healthy here at home. After all, property transactions have been rising recently, and that sounds like good news, does it not? Activity is returning to the market and estate agents are busy again. But I want to be completely honest with you because I believe you deserve the truth, especially if you are relying on your property as part of your retirement security. The market is moving, yes, but it is moving under pressure. There is a significant difference between a healthy market and a stressed market that is being forced to transact. What I am seeing more and more of are forced sales. These are people who have to sell their homes rather than people who want to sell their homes. And for seniors on fixed incomes, this distinction matters enormously because it affects the true value of your property and the options available to you. Let me explain why this pressure is building and why you need to understand it. When interest rates started rising a few years ago during and after the pandemic, many people assumed it was just a temporary situation. They thought rates of 4 or 5% were just a brief phase and that everything would drift back to those wonderfully low rates we had grown accustomed to. But here is the uncomfortable truth that not many people want to admit. Those ultra-low interest rates we enjoyed for so many years were actually the anomaly, not the norm. If you look back through modern economic history, interest rates of 1 or 2% are actually extremely rare. For most of history, rates have been materially higher than they are even today. Before the financial crash of 2007 and 2008, interest rates were higher than they are now, and house prices were still booming right up until suddenly they were not. The real issue is not simply whether rates are high or low. Economic booms and busts are not driven just by the level of interest rates. They are often driven by how quickly those rates change and how rapidly households have to adjust to those changes. What happened was that ultra-low rates were brought in as an emergency measure to stabilise everything after the financial crash. But now, households across Britain are being forced to adjust from those emergency-level rates to something much closer to historical reality. That adjustment is the problem. An entire generation built their financial plans around money being almost free. They took out mortgages, made retirement calculations, and planned their futures based on the assumption that borrowing would always be cheap. By this year, that assumption has well and truly evaporated. Here is where I think most people are looking at this situation completely wrong, and this is especially important for seniors who are watching. People keep watching house prices and assuming everything is fine because prices always go up over time. But in reality, when you adjust for inflation, house prices have actually been falling since the financial crash. Despite those years of low interest rates, house prices are in reality about 25% lower than the peak before the crash when you account for inflation. Most people simply do not realise this because they see the nominal prices going up without understanding that the purchasing power of those pounds has been eroding. But here is the even more important point for those of you in retirement or approaching it. House prices matter far less than affordability. Your household budget does not break when house prices go up or down. What creates real pressure is when monthly payments stop working for you. Two households can own identical homes at identical prices, and one could be completely comfortable while the other is under serious financial strain. The difference comes down to when they borrowed and what interest rate they locked in at. For seniors on fixed pensions, this cash flow reality is absolutely critical to understand because it affects your options, whether you want to downsize, release equity, or pass your property to your children. This is why this year matters so much, and why I urge you to keep watching until the end, because there is actually some hopeful news coming. The years leading up to and during the pandemic saw more and more people taking out 5-year fixed mortgages. Literally half the mortgage market consisted of people locking in those incredibly low rates for 5 years. When rates increased dramatically, those existing mortgages stayed low because they were fixed, but they have been rolling off gradually year by year. People have been forced to remortgage onto these far higher rates, and it has been a painful adjustment for millions of families. However, by the end of this year, the bulk of that ultra-cheap debt will have left the system altogether. We will have essentially hit the low point of this painful transition. For every household refinancing their mortgage right now, it does not feel like a small adjustment. It feels like a genuine shock to their finances. Not because they borrowed irresponsibly 5 years ago, but because the rules of the game changed underneath them completely. Most homeowners will not necessarily default on their mortgages, but what happens instead is that they cut their spending dramatically. They delay moving house, they avoid taking any financial risks and prioritise stability over everything else. And that cautious behaviour ripples outwards and affects the entire economy, including property values and the options available to seniors wanting to sell or downsize. But here is where things start to look more positive, and I really want you to hear this part. The reason this year is actually a turning point is that by the end of it, everyone on the housing ladder will have adjusted to this new normal. Anyone entering the housing ladder will have done so at these current rates. The housing market can finally acclimatise and stabilise. People who fixed their mortgages back in 2022, 2023 and 2024 at the very height of interest rates will actually start renewing at lower rates than they originally secured. The way to think about it is that people already on the housing ladder will have an easier and easier time staying on it as we move forward. Now I want to address something that particularly affects those of you who bought your homes decades ago expecting them to build wealth for your retirement. Homeownership simply does not build wealth like it used to. Looking at house prices adjusted for inflation tells a very different story from what most people believe. Over the last 20 years, house prices have actually fallen about 25% in real terms. But the 20 years before that, which is what many people still have in their heads, saw prices increase by 241% when adjusted for inflation. So if you put all your money into buying a home back then, simply owning that home created enormous underlying wealth. If you have been counting on your home to fund your retirement in the same way your parents' generation did, you may need to think about this differently. So where does this leave us? House prices are not collapsing, but adjusted for inflation, they have been sliding backwards for 2 decades. The end of this year will see the last of those painful adjustments from low to higher interest rates, and things should get easier for those on the housing ladder moving forward. But it will remain challenging for younger people trying to get on the ladder until we properly balance housing supply against population growth. The question remains whether the UK should follow America's lead in banning corporations from buying family homes and intervening in mortgage markets. Could that help? Or would lowering mortgage rates for everyday buyers simply push prices up further as more people compete for the same limited housing stock? The challenge is that you can change who buys, or you can change the monthly payment, but if you do not change supply, the market simply reprices around whatever new rules you introduce. I would genuinely love to know what you think about all of this, especially if you are a senior navigating these uncertain times. Please leave your thoughts in the comments below because I read every single one, and your perspective matters enormously. Understanding the property market better helps all of us make smarter decisions about our homes and our futures. If you found this information helpful and you want to stay informed about what is really happening in the UK property market, please subscribe to this channel and hit that notification bell so you never miss an update. These are genuinely important times for property owners across Britain, and the more we understand together, the better prepared we all will be. Thank you so much for watching, and I will see you in the next video.